Hey everybody, it's Billy Kinberg with Intercoastal Mortgage. Today, I want to talk about interest rates, why they've been so high, what's happening now, and where we think they are going. The most important thing I need you to take away from this video is what does and what does not directly affect 30-year fixed rate mortgages. If you watch the news, you will constantly hear talk about the Federal Reserve, or the Fed, raising or lowering rates. What they're referring to is the Federal Reserve's Open Market Committee, or FOMC, which meets approximately every 8 weeks or 8 times each year. At these meetings, the FOMC discusses fiscal policy to ensure that the Fed is doing all it can to steer the economy in the right direction. Mostly, what people take away from each Fed meeting is whether or not the Fed raises or lowers interest rates. But the underlying discussion that is presented in the minutes of each meeting is also very important information. One of the ways in which the Fed can affect fiscal policy is by adjusting something we refer to as the federal funds rate. This is the interest rate that is always being discussed in the news. But this is an interest rate that applies only to overnight transactions when banks borrow money from the Fed or from each other. As such, it is a short-term rate. Interest rates for credit cards, home equity lines, and other short-term loans are directly affected by this rate. Conversely, mortgage rates are long-term rates and essentially unrelated to the Fed funds rate. And this is what I need you to take away from this video. So when the news reports that the Fed is either raising or lowering the federal funds rate, it does not necessarily mean that mortgage rates are going up or down, and certainly not by that same increment. Mortgage rates are more directly affected by many market forces, way too many to discuss in the context of this video. Plain and simple, there is no direct correlation between the federal funds rate and 30-year fixed rate mortgages. The Fed uses changes in the federal funds rate to try and steer the economy in one direction or another. And these changes can, and often do, affect some of these market forces that in turn affect mortgage rates. So over the long term, the federal funds rate and 30-year fixed mortgage rates do tend in the same direction. But again, any correlation to each other is indirect at best. Let's take a look at these composite graphs showing both the federal funds rate, which is the magenta line, and the average 30-year fixed mortgage rates, which is the blue line, over the past 50 years. At times, they seem to be moving totally in sync with one another, but at other times, there are huge differences in their topography. Take a close look at the period from 2009 to 2016. The federal funds rate is flatlined at 0 over this entire period, but 30-year fixed rates varied by as much as 2 full percentage points over the same period. It's also important to understand that the Fed funds rate moves infrequently, at most 1 every 8 weeks when the FOMC meets, whereas mortgage rates change every day, and it's not uncommon for them to change 2 or 3 times within a single day. An easier way to think about this is the Fed is changing rates deliberately, using them like a tool to drive the economy in the direction they believe is most favorable. Conversely, mortgage rates are moving in response to different factors in the economy. It's not uncommon for the Fed to announce a change in the federal funds rate in one direction or another, and have mortgage rates move in the opposite direction the very same day. So remember, the Fed funds rate changes are intentional, but mortgage interest rates are reactionary. So here's the bottom line. Of all the factors that affect mortgage interest rates, the most antagonistic is inflation. As inflation rises, so do mortgage rates. And as we know, inflation has run rampant since the end of the COVID pandemic. This is the primary reason why interest rates have been elevated. Conversely, the Fed has attempted to manage inflation by raising the Fed funds rate. Now, not everyone agrees with the strategy, but there is economic precedence, and this is the course they've chosen. Now that inflation finally appears to have hit its pinnacle, and the Fed has acknowledged that it may be declining, mortgage interest rates have begun to come down as well. And the Fed has indicated that they will likely be lowering the Fed funds rate at future meetings. Some mortgage interest rates have already come down a full point from they were just a month or two ago. Now, nobody has a crystal ball to predict exactly when mortgage rate interest will come down, how far they will fall, or at what pace they will decline. Conservatively, we expect rates will drop slowly over the next 18 to 24 months. We don't expect that they will drop anywhere near the same historic levels that they did during the pandemic. So don't expect interest rates in the 2s or 3s anytime soon, okay? But they should come down enough that those individuals who bought a home in the past 2 years will have an opportunity to refinance and reduce their monthly obligations. These lower interest rates will also be a significant factor in pushing more individuals off the fence and driving them into the home purchase market. As always, I'm here to answer your questions about inflation, rates, anything mortgage related, so please feel free to reach out to me anytime to discuss anything at all. I hope you have found this video informative and engaging, and I hope you have a great day. Thanks so much. Talk to you soon.